Hello and welcome to Property Question Time. I'm Stephen Galpin and this is a show where you can have your property related questions answered by our team of experts. And very pleased today to have with me Zee Razaq, who's CEO of Razaq Accounting based in St Albans. Welcome to you, Zee. Good to have you back.
Hi Stephen, thank you for having me.
And Howard Bowes, CEO of Harvey Bowes Property Finance Brokers. Welcome to you.
Hello Stephen.
Okay. Good to have you guys in today, and we'll get straight on with the questioning. And Zee, you're going first. I'm currently building a buy-to-let portfolio and would like to know if the experts believe it is better to hold the properties individually in my personal name or better to be each in a specially formed limited company. I've had totally conflicting advice in the past. I'm not so interested in the tax implications, but more the management and future leverage of funding aspects. Now, I know as a tax expert, you're going to say, well, it is important to worry about the tax. So off you go.
Really good question. There is a combination here. As we've spoken on many shows, you have to think about a number of areas, not just accountancy tax. You have to think legal and financing. And that's a very financially geared question. Leverage. The types of leverage is so key. If you have leverage, i.e. borrowing money in a limited company, the rate tends to be higher, and I'm sure Howard will clarify this with us as well. But in your own name, the financing costs tend to be lower. So you have to factor that in when you're making your decision, and depending on what scale you're going to do. And I think we've had conversations before about this. Then it comes down to risk as well, i.e. should it be in a limited entity or not? And it's that balance question. You can't just think about, am I going to get the money? It's important to buy the property, but is it going to make me money? And what the end implication is from a tax and risk perspective as well. Hopefully that's made sense and sort of unpacked a question for the viewer.
Well, I think what I'm going to say is, do you want to answer the question? Is it better in a limited company or is it?
Really good point. In the sense, for me, it depends on what your long-term aims are. Because as I've mentioned, it may be a temporary benefit in your own name from a finance perspective, because the cost of finance is lower. But if the tax is higher and you don't weigh all of those up together and all the factors, then you're going to lose out. So what's the point? So you need that evaluation, don't you? You need to look at what's the tax benefits, i.e. tax on interest in your own name, or the financing costing. Is it going to be cheaper than limited company? What's the differential? And what do I want to end up scaling the business to?
Yeah, I know. I mean, I've got a feeling. I know where the question is coming from on this. I mean, in past years, I've had advice from accountants that have said, you must do this. That's actually conflicted with what property experts have said I should do. And I think the question here is more leaning towards, look, forget the taxation side of it for a moment. Although it is important, I agree with you, as to whether where you take your advice from in these matters, because your accountant is, your difference is that you're a specialist in property taxation. A lot of accountants are not, and they will just give pure, straightforward, book revised accounting advice, rather than industry-specific advice. And I think that's what the question is getting at here. Where does he take his advice from?
I think it's a really good point. If you go to a generalist in everything, you'll get general advice.
Yes.
If you go to a specialist, you'll get specialist advice. And as you mentioned, I didn't mention taxation as the primary driver. I said that you have to think about risk and the cost of leverage.
Yes.
Right? If the risk, cost of leverage, tax, these are all have to be put together and done in an evaluation. So you can only give advice depending on the person's circumstances on all these different areas. If you say generically, oh yeah, in your own name because the cost of finance is low, forgetting the tax and forgetting the risk, that's not good advice, is it?
No.
If I say limited company, and that may be good from a limited liability and maybe a tax potential perspective, but then the cost of financing cripples you,
yes,
that's not good advice either. So you have to look, and that's why you can't say one way or another, and that's why I was trying to give that
and again, from a very
answer.
small investor's point of view, the cost of running a limited company is there, and I know one of your favourite subjects is the sort of exit strategy. It's not always that easy to exit from a limited company, that simply, is it?
Depends who you come and see, Stephen. Let's be honest, yeah? If you go to see a specialist, and we had this off air and we're having a conversation, when you go to your doctor GP, and I love using this analogy, if you go to your doctor GP, you don't expect them to start opening your heart and start doing surgery there and then if you've got a heart problem, do you? So why do people feel they go to a generalist accountant who's got general skill set and think they're going to get specialist advice? And I think that goes to the root of the question.
I think you're right.
Right?
Yeah.
If you get specialist advice and someone like myself who's articulated the holistic view, looked at all the different areas and got people like Howard involved, because you can't just think of it just from your profession, because remember, we're entrepreneurs. We have to think about the whole overview and then make the right decision for that person. I hope that really does answer it this time.
It does indeed. You're forgiven.
Thank you very much.
Okay, Howard. Many short-term property finance providers advertise that funding is available for experienced and new property industry persons and companies alike. When evaluating whether an application will be successful in securing funding, what are the main criteria for this? I am an inexperienced aspirational developer investor looking for funds to start me off. Prior to securing long-term funding, when the purchase of land and property is fully completed. Now, I guess the inference here is that he's perhaps not quite sure, perhaps from Zee's point of view, where he's going to enter and exit the industry here. So he's looking for funding to quickly purchase something that may be an opportunity, but is looking for fairly flexible long-term funding. So there you go. How would he get on?
Well, I think there's some ambiguity in the question. But so if I can answer the question from two perspectives, the first one being really that, you know, if somebody is looking to as an inexperienced investor, they want to start investing in property and they want to do some speculative, so perhaps go for planning when they've got a property under option, etc., and get funding for that, because planning these days is quite expensive, then you're not going to get that funding from an institutional funding line. You need to work with private investors that might give you money towards what we call those soft costs. So the research costs, the planning costs. If, however, you've actually got a property that you're looking to purchase or land and you want to develop that, then you have more lenders that will support you if you are an experienced investor. But we have a good range of lenders that will also support somebody who is new to investing and new to development. And the key to whether that application would be successful is not just the project itself and whether the project is viable, what research has been done to that point, but also who the team is behind that investor. So a lot of the lenders will actually credit check the building contractor that you propose to do the build, for example. And so getting everything lined up from the planning to your QS reports, which works out the costings, and taking that through then as well to the other soft costs that you have, the preparation costs, the consultancy cost, and getting a JCT contract in draft form ready for a lender are the sort of things you'd be expected to have in place in order to draw down funds.
Yeah, I think that's excellent advice. I mean, one of the most regular questions we get on the programme is, how do people start off? How do they enter the market? And our collective advice is usually make sure you've got your experts in place, because it's those experts that are really in control of your development. They control the finance, they control the timing of your project, and the I suppose the competence of the programme that you're proposing. And a lender's got to look at that, haven't they? I mean, that's the be-all and end-all of it. Do you find your clients are pretty savvy to this, Zee?
I think Howard made some unbelievable points, and that is my experience as well. What you need is a project evaluation, right? You need to do a financial appraisal and make sure you've got all these different aspects covered and know what the cost of finance ultimately is, because that will change whether the project is going to be successful or not. And also, what are you benchmarking? I think we talk about exit, but I always say the journey is important, right? It can be enjoyable or very painful. And if you don't measure the performance, because when you're talking to financial institutions or people lending you money, you have to be able to say, what is it against the plan? This is why I asked for the money, because it's done in dribs and drabs. It's not done, here's all your money, off you go. It's done, certain milestones have to be hit, and therefore you have to evaluate them, especially as you get bigger and more complex. And that's how you do a real project appraisal, and you have to have the right support. Absolutely.
Howard, what do you think of this sort of scenario of getting short-term finance initially and then converting it to longer-term finance? Is that a bit dangerous? Because if you persuade the short-term financier to do it and then you can't convince the long-term financier, you're in trouble, aren't you?
You would absolutely be in trouble in that situation. So the most important thing is it comes back, as we've spoken, as Zee has spoken as well, about begin with the end in mind. So you'll need to know who that funder is that's going to be your exit funder, your refinance funder. And you could actually finance a typical development project, could go to 3 different potential lenders. So if you're going to secure it by purchase prior to having planning, you could take a short-term typical bridging loan that converts to a development loan. And it could be actually with the same lender, but a different categorized loan, or it could move lender. And then once you finish the development, onto a long-term loan. The fact is, though, is that no short-term lender or development lender will give you the funds to complete that purchase and complete the development without full appraisal and belief that you are going to get that funding at the end. So the term loan, the strength of a term loan application will always be assessed at the start by the development funder.
Yeah, I think, there's one important thing to remember when they do this. I mean, my bank manager from many years ago used to say to me, if I say no, don't argue with me, just think why. And I think if you can't get your professionals to get all your ducks in a row, get all your funders in place because they're nervous or they're worried about where you're going, then good thing to listen, isn't it? These are professionals. Okay, well, there we are. That's all we've got time for in this half of the show. So join me again after the break when we'll be asking Zee and Howard more of your questions. Hello and welcome back to part 2 of Property Question Time. I'm Stephen Galpin and I'm with Zee Razaq and Howard Bowles, who are going to be answering your questions. Now, Zee, I know this question coming up is perhaps not directly in your field, but I'm sure you're going to give us a good answer because I think the question's a little bit wider than it appears. The question is, what is the panel's view of the various no deposit rental occupation schemes that are currently available? Now, just to explain, you often see agents advertising no deposit required on rentals. Some of these go even further and say no deposit, and as a landlord, we'll pay you the entire rental fee for the year up front. But of course there's a cost to it, as with most things. And I think the question really is asking what are the consequences of these schemes? And I think it really does matter to your company management or even your individual management of your portfolio. Because if you're going to enter into a situation which encourages bad debt, then we're all going to have a problem, because the buy-to-let market actually runs on fairly lean margins anyway. And if you get an excess of voids or you get excess bad debt, then it's really a problem. And I just wonder how, I mean, you've got a lot of landlords, HMO landlords, buy-to-let investors with quite large portfolios. I wonder how you cope with bad debt and how you view these schemes in relation to that.
This is a really interesting question because the area is quite complex, and we'll try to summarise, as you rightly said, and focus on areas. If you've got it in your own name and you suddenly have bad debt, because it's done on a cash basis, it's a non-result because the rent is declared on a cash basis. That's the difference. But when it's in a company, it's not based on a cash basis, it's based on the actual time period, i.e. the invoice. Then it becomes a problem. And there's special rules how you recognise bad debt, and these are changed from an accounting perspective, but the knock-on is on the tax perspective. The basic test that HMRC push out these days is how unlikely are you ever going to be able to recover that money? And that sounds easy, but it's not. Because when you got in your limited company and you've recognised and said, hold on, I should have had rent because it was on invoice, but they didn't pay me the last couple of months. I've had to declare the income. I have to wait until I can prove that I'm definitely never going to receive that money. That is a bit of a complicated process.
And what would they want to see in terms of proving, for instance, that you've taken, what shall we say, every reasonable step to recover?
Really good question. Previously, it used to be a bit easier because we're using accounting talk here. I know people will be like, oh, okay. I used to do a provision and say, look, this is doubtful. We're not going to receive the money. The the targets become, or the benchmarks become a bit higher. We have to show that you've gone through all avenues to be able to recover that money. And normally, especially in trading businesses, it's around, have you got legal letters and things, and they've declared that they're bankrupt, or they can definitely not pay it. And that is quite hard in the property market. And this is where the big challenge lies. I know it's a bit of a diary.
Well, quite often, you'd never know where the tenant's gone if they've cleared off.
I think as long as you've taken reasonable steps and you've wrote to them, and it's clear for anyone from a reasonable perspective, when they're looking, they're not receiving the money, then you can declare it. But there's a timing, and this is my point. So in your own name, I received the cash, no problem. The bad debt doesn't matter. In the company, it does matter, because you report your year-end accounts, you reported income, which you haven't received. And then you have to declare in the following year, that's actually bad debt, or we're not going to receive it for a credit note. That is the challenge. Okay. And therefore you could have paid tax on something that you've not received.
You see, I'm presuming that these schemes, let's take the simple one, which says no deposit. Effectively, what that insurance company, which is what I guess they are at the end of the day, is saying to you, look, if you fall foul of this no deposit business, we'll make that 5-6 weeks deposit up for you. But presumably that is with conditions and subject to everything else being the norm, you know, that the tenants, you've given them the right information about the tenants. I'm sure there's all sorts of caveats that would, you know, relieve their responsibility. How would you sort of account for that in terms of accounting?
So the deposit is key, and that's why, because the deposit goes as an asset, right? So what happens is the client who's given you a deposit, right, is against future revenue. Technically, sorry, it's a liability, not an asset in this case, right? Even accountants are getting. And what happens is when you don't get the rent, you offset that deposit, and you therefore recognise it as income because you've already got the cash, but that has been sitting on the balance sheet. In this case, you've got none of that. No. And then you have to go through this bad debt aspect, and it really becomes quite messy.
I suppose in a way it's a little bit similar, isn't it, to the VAT scheme, that you either pay quarterly on pure accounting and invoicing and so forth, and the receipt of the money becomes inconsequential. It's based on invoicing, isn't it? Or on the cash system, where it's based purely on cash coming into your account. So I suppose there are similarities of that kind of...
Really good point. I did a talk on making tax digital, and VAT is a massive area in that. And one of the areas that people always forget is if your business is below 1.6 million turnover, you can use cash basis for VAT if it's relevant, because you know a lot of rent is exempt. So if you had a service accommodation, furnished holiday let, or a commercial building, you charge VAT. In that case, the VAT I would recommend to be based on cash, to avoid this headache, because for bad debt for VAT there's other special rules. So we would get into that. You have to do 6 months, 7 days and prove. So the rules for VAT are different to the corporation tax rules. And try to keep it simple, right? Get the advice at the beginning, try to make your life easier. Most entrepreneurs don't have 1.6 million pounds worth of turnover in their rental businesses. Therefore, cash basis will be a lot easier for the VAT from my perspective.
Well, on that uncomplicated note, we'll move on to Howard's question. I'm about to apply for short-term funding to purchase a property at auction. The property will require substantial refurbishment and remodelling, and it's my intention to apply for planning consent, and when obtained, look for long-term funding for the project. I am, however, nervous that if planning takes much longer than anticipated, I need to know if the short-term funder would be likely to agree to an extension, and for obvious reasons, it's not a question I want to ask directly at the point of application. I sort of kind of get that.
Yeah, very interesting question. It's good to see towards the end of the question that cautionary thing about how long planning is going to take, because I like the assumptiveness that planning is going to happen, which is also in the question. So,
yes.
You know, I think the first thing is with my investor hat on as opposed to my finance hat on, I think you should always go, if you're going into a project and it's subject to planning, you either know the local development plan inside out and you're pretty sure you're going to get planning, or if it's speculative, you need an exit B and an exit C contingency if you don't get planning. But in the question in itself about whether you tell that short-term funder, then it's really important to be open and honest actually with the short-term funders, because they've seen it all before. You know, there's a vast amount of experience there, and especially if you're using a broker that's got a vast amount of experience as well, then those are conversations you want to be having right at the start. What happens if I don't get planning? Or what happens if planning is delayed? And through the whole COVID period, we saw planning delayed by huge amounts of time, and that's still the case. Will the short-term funder allow you an extension? It was in that question, and the possibility is there if there's still enough margin to cover costs of extra interest and still be a profitable deal.
Might it be expensive though?
Well, now this is a fantastic point, Stephen, actually, and there's a way around this that you'll be pleased to know. So first of all, to answer that question, yes, it can be expensive. So if you take up the full allowance of your term on short-term bridging funding, you could be looking at administration fees and then what we call pecuniary costs, which are additional costs each month. Yep. And typically your interest rate could double for the months where you go over term, and that can take the profit out of a deal or result in the deal making a loss overall very, very quickly. But the key to it is first of all, have enough time in that deal, in the term of the loan, put enough time in place so that the term gives you the contingency plan that you really need. Now, the difficulty with that for some investors is that if they're working on the interest being deducted at source at the beginning, which is the case, the longer your bridging term, the less money the bridging lender is advancing you on day one. So the bigger deposit, the more money that you have to put in as the developer or your mezzanine finance, your private investors. You need a greater fund for that side. So the way around that is that, let's say, for example, you estimate planning is going to take 9 months. You might choose to take a term for that period until planning comes of what we call a 9+3 or a 9+5. Okay. And that is actually where you agree with the bridging funder that you have the first 9 months with the interest deducted, and then you are allowed at the same rate to service the interest for the next 3 or 5 months, whatever that +3 +5 is. And it's a recognized term in the industry. It's something that's recommended to a lot of developers to build in a contingency so you don't hit pecuniary costs.
It's quite interesting you pick up the point about planning there. I think time is often a thing people don't consider enough. You know, time is the be all and end all of property development, in my view. It's the one thing that causes the real problem that everybody forgets about. But also it's the attitude of developers sometimes to planners. I've always found actually, you know, most local authorities will have a full-time planning officer on duty every day, you know, duty officer, who will advise you and guide you as to what you're intending to do. And so many developers treat the authorities as sort of the enemy, rather than go along and say, look, hey, this is what I want to do. What's your feeling? Because that duty planner will take you along the journey that planning committee want to see. And that's so important, and it's so important not to fight it, I think, because it can become so expensive, both in terms of time and effort. But there we are. Well, look, thank you both very much for coming in. So, Zee Razaq from Certex Accounting, thank you for coming in. Thank you. Howard Bowes, CEO of Harvey Bowes, property finance company, thank you very much for coming in. Great advice that you've given, really appreciate it. I'm sure we'll be having you both on again very shortly. That's all from me. So thank you for watching Property Question Time. I'll see you again next time.